Good morning, folks, and welcome to today's video. So today I have three pairs on watch, and those are Euro CAD, CAD Yen, and natural gas USD. So I'm going to break them down for you now, and as always, give you my thought process and tell you what I will be looking for in terms of entries for the day ahead. So on the weekly chart, we have on Euro CAD, we have the sharp move down, which I talk about a lot. Sharp move down, sharp move up. When these moves are sharp, if you think of them like as a drawing pin or a tack, if they're sharp, then there is often a lot of liquidity here, or a lot of liquidity that will be placed in this area for a potential move in the opposite direction or in the same direction which price rallied to the previous time around. So, and we know that price tends to rally or sell off with a similar level of aggression as it did the previous time around. And if we just zoom to the right, you can see that we tapped into this area with a similar level of aggression and then rallied with a similar level of aggression as we did here, okay? And as we know, on the higher time frames, we tend to break, if we're going to rally to the upside, we tend to break below the area of value rather than just tap into it. And the same applies on the flip side if we're looking for shorts, okay? And I've touched on this previously, but that has a lot to do with the fact that the media pay attention to the higher time frame liquidity points when they put out their stories. So they will say things like Euro CAD at 8-year low, which makes people think, oh, it's just going to keep selling off and selling off. So if there's any inkling in a trader's mind where they're trying to get rich quick, so to speak, then they will think to themselves, either consciously or subconsciously, this is just going to keep going, especially if they believe what was previously support becomes resistance when price breaks below it. So they start selling, and then the bigger players, unless there's been a fundamental change, which we're usually able to see on the lower time frames and sometimes on the higher time frames by way of the market structure, the bigger players see this as a bargain area of value for a buy. So they start buying, and then boom, we see this to the upside. So that is basically what we call mass psychology. Those of us who trade the Falcon strategy, if you'd like to learn more about that, and you're watching either on TradingView or YouTube, then you can find more information about this via the link on my YouTube profile. But more about this pair today. So we tap into this low and then we rally to the upside. The market tends to move in terms of impulse, correction, continuations. Okay, that's the natural ebb and flow of the market. You can see that here: impulse, correction, continuation to the downside. And we do tend to form these larger structures about halfway within a range. So within a range, in this instance, I mean from here to here. We also, if we're going to rally to the upside, so just looking for that impulse correction continuation today, we also tend to have, not all the time, but we tend to have near misses. Okay, so when we have a near miss to an area of value where price has scooped back up, not quite tapped into an area, and then pushed down, that actually makes it more probable that this impulse correction continuation will play out. So as traders, we're just stacking the confluence factors in our favor and trying to have as few negative confluence factors as possible. It's rare that you get no negative confluence factors, but we try to have as few as possible and to filter the pairs that we look for so that the pairs that we have on watch have the most positives against the least amount of negatives. Okay, so just common sense. So as we zoom in a little bit, what do we have? We have this sharp move down followed by a sharp move up. Price comes all the way down but fails to tap into this area. I've talked about this previously, that I call this the FOMO leg. Not everybody that got long here had FOMO, but there certainly would have been a high percentage of people that did, okay? And we know that trading is to a large extent psychological. So people see it start to move and they get FOMO, many of them, they start buying, and then what we see in the majority of cases is price come down to the area of value. And as I've said, if it's a higher time frame liquidity point, it will usually break below it before rallying to the upside, and we tap into that area. We stop everybody out and we take out all the limit orders, and then price rallies to the upside. Okay, so we now have this kind of confirmed morning star formation. bearish candle, stall in price, and then a bullish candle which closes above this. And you might be thinking, well, this is very bearish. This weekly looks very bearish. And if I just drill down, you might be thinking, well, this looks very bearish as well. Indeed. But what reason does price have to come all the way back down here when it's taken out all the orders? It can do that. And if it was to do that, then that may be to fill this bullish wick. But typically speaking, the wicks that get filled are bearish wicks more often than not. So if we have a bearish candle as opposed to one that's slightly bullish and the wick below it is red, then that is more likely to be filled than a bullish one. But of course, anything can happen in trading. We have to remain neutral. However, if you just look at what happened last time around, so when we had this impulse up followed by this correction, and if you look here, price came down, it tapped into this area, and then it pushed up. You can see here, we got a very, very bearish candle, which broke above this and then closed below it. And then we just rallied to the upside. So price had no business and no reason to come all the way down here because it had already scooped back down and taken out all the orders. Okay, it tapped into this area. And in this instance, we actually broke below the area of value, which makes price even more likely to push up. But we have to be neutral enough to know that price can do anything at any time. And as long as we do that, we don't blindside ourselves to things that we've learned to see that we're unable to see because of the fact that our bias is too confirmed in one way or another. That's why they call it confirmation bias. What price could be doing is the impulse correction continuation that we typically see, and it could be filling this wick here before pushing to the upside. Okay, so I'm just trying to remain neutral to all possibilities, but also to what I've be open enough to forecast what I've actually seen play out in the past. So you can see that we had the impulse correction continuation. We broke below this area of liquidity here, which gives me the indication. I've said normally when they're sharp, price will react from these areas, but the reason it didn't react from this area most likely is because if you look at this is abnormal price action. We don't normally see sharp move up, sharp move down, and then start coming down again. That gives me a clue that this move was just volatility, most likely caused by news of some description. I think that may have been, I'm not sure what was out last Friday. I'm not sure if it was NFP. It may well have been. I can't remember now, but it's irrelevant. We don't actually trade the news. But that gives me a clue that this was volatility, and that explains why price basically disrespected this point almost entirely. Okay, so what I'll be looking for today, with all of this in mind, and bearing in mind that we've done what we need to do on the higher time frames, and I don't know why my okay, I did have a ray line on the chart, but that's mysteriously vanished. So let's get that back on the chart, right? So that is the area of value. There we go, area of value. Let's put this guy in his box, put that in the forecast. Right, what I'll be looking for today is for price to tap into this area. You might be thinking, well, what about this one? It could tap into this area, but if you just look at, it wouldn't surprise me, that is the base of a piece of structure. So we have this kind of running channel fill. We also have this 1, 2, 3. It could tap into this area, but as a minimum, I'll be looking for price to tap into this area today, which just so happens, if I measure it with the Fib tool, Fibonacci, if we just measure that, that's, as I say, it wouldn't surprise me if we tap slightly lower, which would be the 50% mark, but as a minimum, tap into that area of value and then push up, because if you look last time around, where did price react from? It reacted when it moved down to here. This is where it reacted from. So that gives me a clue that the liquidity is likely here. Those who've moved their stop losses to break even would have it here. Those who've got their stop losses just below would have it, have their stop losses just below. And of course, if it moved with that level of aggression, then there was likely a lot of orders placed there, so there will likely be a similar number of stop loss orders just below or at this area if people have moved it to break even. But as looking at this little bit of volume coming in now, it wouldn't surprise me if we push a little bit lower. Just looking at this, just out of instinct, I can tell just looking at this that we may push a bit lower. So we may actually indeed push into this area as well. But that would be even better, because if we pushed all the way down here and then pushed up, then we would have completely washed out all the orders that were here. for that potential move to the upside. So that's what I'll be looking for. Price to tap into here, a push back up, followed by a flag, which is the confirmation that we look for, that price is actually going to push higher, because in the majority of cases, this is the banks and the big players stacking their order for the next move to the upside. And then I would look to get long rather on the break of the flag or within it, if we had the two confirmed tops of the flag. So that's what I'm going to be looking for today. I have an alert which may trigger, you can see it's there, by the end of this video, and that is Euro CAD. Of course, if we do tap into that area and we push up and we don't flag, if we start messing about or pushing back down again, then I will just disregard this, because then it could be the case that we're forming something more complex or coming all the way down to the bottom to retest this low. But of course, that push up and that correction afterwards, which is the key detail, is the confirmation that we're not going to just push to the downside, or as excuse me, as much confirmation as we could wish to look for, wish to see as traders. Nothing is 100% confirmed. So that is Euro CAD. So on the flip side, we have CAD yen. So we have this, excuse me a minute. we have this sharp move up here, sharp move down, and then we have this overall, there's not really there is a bit of an inflection point here, but just we have this overall 1, 2, 3 wave move. And as I've said, typically when we have these completed structures, which also tap into this sharp move and a sharp move down there, that would normally indicate that we would get this impulse correction, and then this correction would act as basically the building of volume, price building volume for the next leg lower. So price is either finding volume from sharp points such as this, or it's building volume for the next leg in whichever direction it's headed after the impulse and the correction. Okay, so normally we would anticipate a move to the downside to potentially take out this near miss to the start of the structure, which we call the 90% rule, the base of a piece of structure. But sometimes price has other ideas. Sometimes price forms a scoop double top before it goes. That is something we see. Okay, so we kind of have we have the push down, and sometimes what we also see is these M style patterns. So I touched on this yesterday, where we get this kind of M or W style pattern. Price taps into this area. These tend to cause, I would imagine, mass confusion, because you won't find these patterns anywhere. I suppose there may be, I was thinking yesterday, there may be some of these butterfly type patterns. I forget what they are. I can't remember all of the patterns, but these, you get the butterfly pattern, the Gartley pattern, and all those. I believe there's one that looks a bit like this. It may be the butterfly pattern, but I think typically speaking, these cause a bit of confusion. But regardless, we scoot back up, so we can focus on the most recent piece of price action now, which is here. And we push down, we push back up, but we do so in the form of a bullish wick. Okay, so we have a green candle with a bullish wick. Normally these get filled. We also slightly near missed to this area, so it's no surprise to me that we came all the way back up. We then near missed to this area again. This was likely a bit of a FOMO channel. Price pushes down, pushes back up, takes everybody out that got short here, and then we tap into that area, and then we push down. Okay, so we break above on the higher time frames more often than not before we see the push off, the sell off to the downside. We have that confirmed evening star formation, bullish candle, stall in price, and then a red candle which closes below this candle and retraces, in this instance, pretty much the entirety of the previous green candle, the body of the green candle. We have that wick, but I touched on this yesterday. When a wick is a wick on multiple time frames, it's usually just volatility, so we can kind of disregard that. So then I ask myself, where is the liquidity sat? Where did price sell off? I mean, once again, this is volatility, so I'm mindful of that. But what I'll be looking for today is the following. So if we tap into where there was a bit of a sharp move up and a sharp move down last time around, we would have washed out all the orders that were sat just above here. And there may be a few just above this consolidation as well. If we tap into that area and then push down, then I'll be looking once again for that flag, but on the flip side, and I'll be looking to get short either on the break of the flag or within it, and then I'll be able to manage it down to these lows and even down to this first inflection point here for something in the region of 2%, just in case we reacted from that area and formed something a little bit more complex. But just looking at this, it wouldn't surprise me once again if we, on the flip side, if we pushed a little bit higher, because if we just measure I'm just measuring from here to the top of the correction. Often we will move out of the correction by a similar amount, a similar height, so which would take us into these areas and would be a bit more proportionate if we were forming that kind of more of a sort of head and shoulders structure, that kind of left shoulder head, right shoulder structure. Okay, so we'll see what happens. Once again, I've got an alert just below that area of value, and if we just measure that once again and ignore the volatility spike, that just so happens to be exactly a 50% retracement, or more or less. Okay, so that is CAD yen. I'm just going to speed up. So natural gas, we were looking at this yesterday. I said this was pretty textbook. We have this area of value here, a near miss to that area, which would likely be filled. We have a near miss to the area, which near missed the previous one, making it even more likely that it would be filled. We tap into that area, we sell off, but once again, we don't commit. We then break to the upside, no doubt around the fundamentals, which just so happen to tie in with the war in Ukraine. So it's no surprise to me that we got this kind of mass volatility. Price comes down. People saw this as a retest. It goes long. It comes down again. It then pushes up. But then we have this kind of, we're anticipating by this point a move to the downside because we have this left shoulder head, right shoulder. We do push to the downside. We break the neckline being here. Whoops. Let's try that again, shall we? We break the neckline, we completely smash straight through it, and now we are trading well below all of these highs and headed most likely for a move, this impulse correction continuation down to these lows here. Okay, the base of this consolidation here. So we sharp move up, sharp move down. We tap into that area by way of a 1, 2, 3 touch structure. This is where people would likely get themselves caught the wrong side of the market, who believe what was previously resistance becomes support once it's broken above. This is all textbook stuff. You can see we have that impulse correction continuation. The breaks above here. People think this is going to the moon, but where's it going to? It's washed out all the areas that it needs to. We're trading well and truly below all these highs, so it makes sense to me for a move to the downside. The last leg has momentum, which is typically what we see when we're going to sell off. Okay, so this is really textbook in terms of how we trade. We did react from that area, but how I forecasted we would yesterday, but we've moved down correctively. This is not an impulsive move down, okay? And if I just touch on this, I'm just going to zoom into the 15-minute chart and flip this upside down. What could be happening here is that you can see we have the last kind of sharp move was here, okay, which just happens to be part of this kind of running channel, right? What could be happening is we could be getting something that looks a little bit like this, okay, where we tap into that area and then sell off. I don't believe that this is, or rally rather, I don't believe that this is a move to the upside, because once again, I ask myself, where are we actually going to? Okay, there's no reason for it to push all the way blast to the upside. But what we could be doing, and this is something which we do see in very large pieces of structures like this, okay, we could be seeing, I'm just going to have to do this really quickly, we could be seeing what we call an ending structure, where we get something like this, okay, little 3-touch structure at the end of a larger structure before the sell-off. And if that was to happen, this is quite advanced stuff. It took me quite a while to learn this sort of stuff. So this could act as the base, because there was a sharp move down and a sharp move up. That could act as the base for this, this structure like that before the sell-off. So I don't want to get, if I'm trying to sell this today, I don't want to get caught up into that. So what I'm going to be looking for is I'm going to be looking for the following. I'm going to be looking for price to break below. I don't know where my alert has gone. I did set an alert on here last night. It seems to have disappeared. I'm going to set an alert on natural gas on the fly for you now. I'm going to be looking for price to break below that liquidity point and then correct afterwards, because if we get the impulse down and correct afterwards, then that is the confirmation to me that there was not enough liquidity at this sharp hook point to send price to the upside, and that ending structure that I was just talking about, that 3-touch ending structure, has been negated. Okay, if we break below there, then that, in my opinion and experience, is off the cards. So the correction afterwards would confirm that there was not enough liquidity here for that to happen, and then I would look to get short on the break of the flag, and I would be able to manage this down to this trend line here for something in the region of 5%. That's what I'm going to be looking for today, folks. I hope you've taken some value from this, and I will be back tomorrow with another video. Thank you very much for watching.